The April employment report disappointing forecasters and the markets, too. It showed a gain of only 266,000 jobs versus the 1 million or so that forecasters had been looking for. Lori Heinel is State Street Global Advisors Global Chief Investment Officer, and she joins us right now. And Lori, looking at some of these moves, yield on the 10-year came down. You saw the Dow futures come down and turn negative. You saw the NASDAQ futures take off. Do any of those moves make sense to you, given the news we just got?
Well, I think they underscore the fact that this was a surprise. Certainly consensus being in a million jobs rather, and this coming in really, really weak relative to that, and then the revision downward, of last month's number. So a lot of weakness there, and I think again reinforces the messages that we had last year, where we're in this kind of doldrums for a while, and the only place is to find any kind of relief. We're in the high growth sector, so it's not surprising to see the kind of market reaction that we're seeing.
We've been watching this rotation all week long. The Dow had been the one that had been doing really well. It was up by better than 2% for week to date. The NASDAQ has been down for the week to date. You think that rotation ends with this, or is this a one-off shock reaction, and then we kind of get back to the idea that the reopening's still happening?
Yeah. So we don't want to make too much of today. And again, like you cited, our longer term view is that we are in a recovery phase. We are being in a pro-cyclical phase. We do think that that recovery is intact, and that's going to provide support for that reflationary trade. But clearly, people are very skittish right now. I mean, the market has run pretty dramatically in the first part of the year. So it's not surprising to see some folks perhaps take a little bit of profit taking here, take a little bit of a breather here. But we've thought all along that this was really a 2-year story, not a sprint in 2021. So our view is that this is still an attractive entry point for stocks, but unlikely to get the kind of outsized gains in the short period of time that we've seen year to date.
You're also starting to turn to other sources. You're looking at Europe and other places for maybe potentially better growth?
We are. And again, the U.S. has been the bright spot in a lot of ways, certainly through the pandemic and in the early part of the recovery. And what we've been looking for are catalysts for other parts of the world to start to be attractive. And certainly from a valuation perspective, Europe is relatively more attractive. But because of the overhang of some of its dealings with the vaccination rollout and things of that nature, just not quite as confident. As they start to get a little bit more on the other side of that curve, and we start to see, the U.S. flatten out a little bit more, we actually do think there's opportunity. So we have been redeploying a little bit of capital from the U.S. into other regions, including Europe, but still U.S. remains our favorite region at the moment, at least.
Shepard Smith here. Thanks for watching CNBC on YouTube.